Well, Washington is making progress towards ending the record-breaking government shutdown. Senate passed a temporary funding measure that could reopen the government, but that now heads to the House for approval. With each passing day of the government remaining in shutdown mode, the extent of economic damage grows. And joining us to discuss this is Daniel Altman, economist and author of the High Yield Economics newsletter. Daniel, always good to see you. So let's start here, Daniel. You say that this government shutdown could be, you say, the most economically damaging shutdown in U.S. history. Walk us through that, Daniel. What makes this one different?
Thanks, Josh. This one is different because of its length. It is the longest one we've had, and also because of some of the dynamics between consumers and the government's contractors during this period. We have a situation where there are a lot of federal workers who aren't sure if they're ever going to get paid the money that they would have been owed for this period. So that's a drag on consumer demand. We also have a situation where the companies that do business with the government aren't necessarily getting paid. If you do that for 6 weeks, you're basically dropping about 2% of gross domestic product if the government's not paying any of its contractual obligations over that period. So I'm not saying that we've dropped 2%, but that's the maximum that we could drop within this period. And that would essentially wipe out our economic growth for this year. So the other thing to worry about in this situation is the kinds of commerce and business activity that cannot be recovered. In usual shutdowns that are shorter than this, we expect that whatever gets postponed during the shutdown will just get caught up later on. And economists tend to think that shutdowns don't make a big difference to the economy and growth. But we've seen situations here now where there is stuff that can't be recovered. We have flights that have been canceled. Those flights are never going to get flown again, right? That's money that the airlines are not getting unless they manage to jack up the prices on other seats enough to cover it. And there are other things like licensing and permitting where we can't have as much trade, we can't have as much commerce simply because those goods can't get off the boats in time because the offices are closed. And so when we start to lose those things, because the shutdown has been so long and there's so much uncertainty attached to it, that's when we have real economic damage.
There was, Daniel, this piece, just to lay out the other side here. I don't know if you saw this. The Journal had a report out today, and they put it like this. They note, ultimately, the CBO reckons the economy will be a bit worse off, but not in a way that will be all that noticeable. They go on to say a shutdown, even of this magnitude, is unlikely to leave much of a mark. But it sounds like you're seeing something different there, Daniel.
Yeah, I think there has been a lot of uncertainty in the economy, both on the consumer and business side. And that has not just postponed some purchases, but actually has dampened demand. We have had a terrible few months for consumers and businesses in terms of future planning and being able to make hiring and investment decisions. Just when we thought towards the end of August, early September, that tariff news was kind of settling down and that economic policy had kind of stabilized, we got more tariffs, we got this shutdown, and it's essentially raised the temperature on all this stuff where we were hoping to just let the economy get back to growth. So by doing this, I think we've essentially put everybody on their guard again when they were just starting to relax. And that's going to have long-term effects for the economy.
You also talk about here, Daniel, what you describe as the root causes here of a lot of this. A self-inflicted wound is how you put it, tied to our debt and deficits. Of course, our fiscal challenges well known, Daniel. I'm curious, as an economist, you see those fiscal challenges. What do you think that the policy response is, the policy mix should be?
Josh, there are only three things we can do. As I laid out in the High Yield Economics newsletter this week, we can raise taxes, we can cut spending, or we can try and inflate away our debt. Our debt is about 120% of GDP right now and forecast to continue rising over the next several years to a level that may not be sustainable at interest rates the way they are now. So what are we going to do? Well, we're not very good at cutting spending. We're not very good at raising taxes either. Are we going to inflate it away? According to my calculations, we would need inflation of about 4% per year over the next 20, 30 years in order to do that. That's not something that the Fed is going to be too pleased about. They're not going to lay out the red carpet for that kind of inflation. So we're really in a bind here. And I think shutdowns are part of the pains associated with this belt tightening that we really need. And nobody wants to do it. It's not a popular thing politically, but we have to do it. We see other countries like the UK making progress in this area, Spain making progress in this area, France also struggling. The US is no different. We need to do some of this hard work.
I want to get you out of here on this, Daniel, because you mentioned the Fed. I'm just curious, how do you think the government shutdown impacts the Fed? Because obviously our central bankers, they haven't been getting all the data they would like. And that next meeting is coming up. What do you think?
Well, as I've been saying, the Fed and the rest of us economists, we're flying blind. We can have some access to data from private sector sources. We've seen data on employment from ADP, Revelio Labs, and others. We have some nowcasts from the Chicago Fed and others who use private sector data. But the longer this goes on, the more detached our expectations could be from reality. And that's really dangerous, especially when the Fed is caught between these dual mandates of stable prices and maximizing employment. It's just about the worst possible time for them to be flying blind.
Daniel, always good to see and to have you on the show. Thank you.
Thanks, Josh.
What's the latest that you're hearing and seeing regarding the shutdown?
Yeah, so the longest government shutdown in history looks like it is finally winding down. The Senate voted last night to reopen the government with 8 Democrats joining Republicans, though we did see Republican Senator Rand Paul defect. Now it goes to the House, where Speaker Johnson is teeing up a vote on Wednesday. That is because today is a government holiday and it is taking time to get House members back to Washington. President Trump has said he will sign this bill, and so we expect the government to open by Thursday, likely, if not Friday. And by the time we get to that point, we are looking at a government shutdown that will have ranged about 6 weeks long. It is expected to hit GDP this quarter, but then we will see a rebound in the first quarter. And the Congressional Budget Office had done some back of the envelope math and had estimated that a 6-week shutdown would amount to a 1.5% hit to GDP in the fourth quarter. But then we would see GDP rebound to 2.2% in Q1. Now, aside from the hit to GDP, as you know, we have been lacking major official government data that investors depend on to assess the economy and that the Federal Reserve depends on to set monetary policy. And so we will likely see the September jobs report released in short order because that had already been collected as the shutdown had come upon us. However, that data is going to look a bit stale at this point, and it is going to take time to collect new data and put that out. And we have had a government shutdown. There have been a lot of furloughs. So the economic picture is likely to remain foggy here for a bit longer.
Lou, if you told me 6 months ago the government was going to be shut down for 40 more days and the markets were going to continue to trend higher, I'd be like, I don't know, Lou. I'm not so sure about that call. But what has surprised you over the past few weeks?
Yeah, what surprised me is how long this has lasted, right? Most markets react to, shutdowns as political theater, not a real risk. And the markets 12 months later almost invariably are higher. This one, though, K Street really started to hit Main Street. And this is what I'm really concerned about, is that GDP hit. How does it affect the psychology of the consumer when we have a swath of Americans who were going to work without pay? Other Americans have to look at that and go, all right, what other government services that we rely on could hinder the economic growth. So I'm going to be really careful watching if there are any ripple effects. I mean, you see fast casual restaurants like Chipotle struggling, other names in that space as well. Is the consumer really finally hit its breaking point? That's what concerns me the most. But again, I don't trade C-SPAN clips. I trade earnings and cash flows. And the good news is, you brought it out, earnings season is well underway. Earnings have been, by and large, really strong. So I think that creates a lot of opportunities in this market, even as we hit new all-time highs.
Yeah, I'm glad you mentioned those fast casual chains, Lou. We got a story trending on our site right now talking about slop bowls. I guess that's a new term. I guess I missed the boat on that one. But let me just stand on your point there regarding the consumer, Lou, because I share your concern on where many households are. As this data comes in, even though it is backward-looking, how big a risk is it to the market here that is still at record highs, that some of this data may not be good?
Yeah, I think everyone's going to just put all their eggs in the basket of the Fed cutting rates, right? Expect it to be not good. It's going to paint a picture of a very weak labor market, a consumer that's putting more on credit cards on an absolute dollar basis. And everyone, I think, we've been trained to expect the Fed to cut into that. So we're going to get another 25 basis point cut. I know one of the Fed presidents was suggesting 50 in December. I don't see that. I think they continue on that trend, and that provides the easier spending environment for consumers. I mean, I say this, I'm always looking for the consumer to slow back and slow down, but we haven't seen it historically. I think we've had one period where we've had 2 quarters of declines quarter over quarter in consumer spending. And that was, through the financial crisis and then COVID. Outside of that, the consumer is surprisingly always resilient. So just paying attention to that to see if this is one of those anomalies.
Brooke, what are you keeping
Can I jump in a second?
Yeah, of course. Go ahead, Jen. Go ahead.
So I just want to build on Lou's point, because we have not seen, even though we're going to see a deal to reopen the government, there is no deal yet on those healthcare premiums. And to Lou's point, we are in a K-shaped economy, a bifurcated economy, where the higher end consumer is doing well, but the middle to lower income consumer is increasingly doing poor. And so if they're going to see their healthcare premiums increase, that is going to put further pressure on consumer spending, which has held in here. But I think that is another fly in the ointment and some ripple effects here from the government shutdown.